My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. I took the Dow 40,000 hat in my hands. I had it right there. I noticed the bill, the writing. Couldn't have been a finer baseball cap. And then I put it down, and not on my head, but right on the desk at my day job on the set of Squawk on the Street. I wouldn't put it on. Was I concerned about a jinx? If it was, we didn't avoid when the Dow dipped 197 points today. Even as the S&P edged up 0.09%, and the Nasdaq gained 0.65%. Nice gain there, led by the semis. But I don't think not wearing the hat was about a jinx. It's something else that's a lot more pernicious, frankly. You see, way back in the 80s and 90s, we celebrated each millennial milestone on the way up. Oh, they were hard fought. Sometimes we seem trapped, like when the Dow was stuck in the 2000s from July of 87 until January of 1992. A crash like we had in October of 87 can do that sort of thing. There are other times we just breeze through the milestones. Lots of hats on those with beautiful days up. Then came the turn of the millennium, and while the Dow somewhat held in there, the 77% collapse of the Nasdaq was too much for people to handle. A whole generation of investors vanished. Many never came back. Those that did came back, they got crushed by the Great Recession, when those round numbers reversed and reversed hard, cut by more than half at the bottom. That's when I gave up on the hats. What good was a hat for Dow 14,000 when the Dow's at 7,000? Yeah, it did get that gloomy before March of 2009. Now, though, I'm beginning to rethink my negativity about the hat. What is so bad about celebrating the immense wealth creation? Granted, I know that the Dow isn't as representative as the S&P 500. No kidding. But it still resonates. Why embrace the hat? Let me give some ideas. First, it has been almost 20 years since the Great Recession. That decline was bruising because we had what was known as systemic risk, meaning the entire economic system was in jeopardy. As I survey the landscape here, I just don't see anything like that happening. Now, you could argue that we didn't see it the other time either, but au contraire, a lot of people saw the financial crisis coming. I was screaming about the danger. They know nothing! Back in the summer of 2007, for heaven's sake. That was so long ago that two new generations, the millennials and Gen Z, may have forgotten it. Some of these guys, Gen X, maybe it's ancient history. However, these are people who, for the most part, still have a very negative view of the stock market and their financial future. I think they want to make money in it, but they don't know how. Maybe they need to be lured back in by being a little more positive. That's really the issue. We, my generation, the baby boomers, have closed the door. We're often pictured as the last generation that genuinely believe that we have it better than our parents. I wonder if by not even showing interest in Dow 40,000, am I doing my job? Maybe I should demonstrate some confidence. Maybe this market deserves a little positivity. Second, okay, there are 30 stocks in the Dow. It's not all that diversified. The winners for the last 10,000 points, though, were diversified. American Express, Caterpillar, Goldman Sachs, Merck were four of the top five stocks. JP Morgan, where CEO Jamie Dimon told people that succession is well underway, finished eighth. He says the timetable for retirement is not 5 years anymore. That plus the decision to limit buybacks at high prices caused that stock to tumble $9 or 4.5% today. What matters to me, though, is that Dow 40,000 was a team effort, not just tech. The biggest worry surrounding this market is that it's been led by a handful of tech stocks. But this workhorse venerable index is truly diversified enough to show you that many areas of the economy are still doing very well. These stocks should have been hurt by the Fed's 11 straight rate hikes. They should have been crushed by the inflationary spiral. They should have been annihilated by supply chain problems during COVID. None of that happened. Again, maybe give me the Dow 40,000 hat. Third's the biggest issue. What the heck is the matter with celebrating when stocks go up? Don't we want to make money? Don't I want you to make money? We have so much negativity that surrounds us. We're drowning in it. All of a sudden, something positive falls into our laps. A major milestone is passed. Does it really make sense to scoff at it? 42 years ago, with the Dow hovering at 1,080, I came down here, right down the block, started my lifelong obsession advising people to own stocks. I was surrounded by people who told me that I was out of my mind for wanting to recommend stocks. I had people tell me I was going to crush everyone by telling them that this stock or that stock was worth buying when the market was a giant joke. When I got my chance to do something next year, what happened? I was inundated with words of caution from people who knew a heck of a lot more about the business than I did. They'd seen recession, stagflation, impeachment, resignation. They didn't buy into Ronald Reagan's entire uplifting rap. Hollywood actor, what did he know? So what happens? Well, first, the Dow drops back to 777 in August of 1982. I applied to work at Goldman Sachs because I really believed I'd be right. I was one of the few people that applied. I got hired as a summer associate in 83 when the Dow was back over 1,000. I felt like I was in Jellystone National Park down here. All kinds of bears. Bears on tech. Bears on finance. Bears on bonds. Bears on the government. Nary a bull in sight. But the stock market? Well, it left those people behind. Except for a couple times when the bears were in charge. You got to admit that when you get a run from 1,000 to 40,000, they're a little celebrating, weren't it? Are we supposed to be as underconfident and negative as everyone was at Dow 1,000? Should we not be skeptical, but be nihilists? Should we be nihilists who believe in nothing? Certainly not the idea that stocks deserve to be at these levels, that they should be much lower, that these prices are real, that it's all alchemy. No benefit of the doubt for the bulls? Okay, we don't need to be cheerleaders, but we do need to acknowledge the reality. Acknowledge that the market, however temporarily, got to these levels. That they're not exalted. They're just higher than they used to be. And that's because the companies these stocks represent are doing so well that they can make you a ton of money. If you sell some of these stocks right here, if you want to take profits, you can. You aren't going to knock these leadership stocks down with your selling. The prices are the prices, to be incredibly oxymoronic. Get realistic about it. So maybe bring me one of those hats. I'll wear it proudly for what the Dow has accomplished, not what it will accomplish. We went from 1,000 to 40,000. I can bear witness. Sure, we can go down. We went from 1,777 when I got started. I could have tossed the Dow 1,000 hat and gone and become a lawyer. I didn't. Right call. Here's the bottom line. I'm not asking for noisemakers or champagne here. No trophies. But a baseball cap with Dow 40,000 on it? Hey, lose 2 zeros, and that's where we were supposed to be if I listened to my bearish bettors 40-odd years ago. Turns out, my bettors... they know nothing! Miller in Colorado. Miller.
Hey, how's it going today, Jim? This is Miller and Alan calling from Denver. Booyah, how you doing?
I am doing well. How about you? What's happening?
Oh, I'm doing well. Hey, first time on the show, I wanted to ask you about Alibaba stock. You know, it's had a cheap valuation for quite some years now. You know, free cash flow is improving. Just wanted to get your thoughts on the stock, you know, and risk that investors should be aware of.
You know, I was talking to my buddy Dave Tepper. He's got a huge position. He was one of my 1,000 bosses that I had at Goldman. And we both admit, I mean, this is just one of the cheapest stocks. It's the cheapest stock in the world, cheapest major stock in the world. If you can stomach owning a stock that is from China, buy it. That's what I have to say, and buy some more if it goes down. Let's go to Tom in California. Tom.
Booyah, Jim. Thanks for having me on. I appreciate the tutelage over the years.
Thank you.
My question is Tesla, buy, sell, or hold?
Great question. It's what I call a down stock. There's the preponderance of people who come in do want to sell it. I don't want to bet against the stock down here at 174, but I would buy it in scale. That would mean buying, let's say, 100. You buy 25 here, 25 at 150, 25 at 125, and then 100 at 25, and then 25 at 100. That's the only way I can recommend it because it is a falling knife right now. Ann in Indiana, Ann.
Hey, I'm a Grateful Club member. Thank you for everything.
Thank you. Hope you like the piece this weekend about, Nvidia.
Yes, but I'm still back on the piece, you know, about cutting your losses or battling a stock was world class. Anyway.
Thank you for that. Thank you.
Yeah. Constellation Energy. You know, you do the piece. Then I hear, you know, it's like your pastiche. Then, you know, there's Dow's, Jim Fitterling. And then there's a Herd on the Street piece, Friday in the Wall Street Journal, yada, yada, yada.
Right.
What about starting a position up here?
I'm for it. We've done enough work with CEG and with Joe Dominguez to recognize that this is the power company that all the hyperscalers want. It's the cleanest power. It's nuclear power. And even though it's run an incredible amount, I think it can be bought. Let's go to Paul in Florida. Paul.
Booyah, Sir Jim. It is Paul from Florida.
There we go.
And we've been listening since 2002. So our question is this. What are your thoughts on Monday.com, symbol MNDY, and have you looked at the options? They're nice.
I know a lot of people feel that it's going to get a takeover bid. I can't acknowledge anything. I don't know anything about a takeover bid. I do know this. Monday is a very good Salesforce.com, mini Salesforce.com. You call it maybe a junior Salesforce.com is the way to put it. And they're very smart people. I would not bet against them. Okay, maybe you have to bring me one of these. I don't know. The Dow 40,000. I'll wear it proudly for what the Dow has accomplished. I don't know what it'll do in the future, but I do believe that we must have faith. It's the right call. On Mad Money tonight, Contour Brands has been outwearing the apparel sector, so I'm finding out what's making the parent company of Lee and Wrangler fly off the shelves. Then should you be all aboard Norwegian Cruise Lines? I've got the CEO to see if the company's latest quarter consented sailing higher. And Palo Alto earnings crossed the tape after the bell. I had to sit down with the cyber powerhouse CEO to find out more because once again it looks like, well, let's just say another tough day. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This is generally a tough time for the apparel space, but some companies are doing a lot better than others. Take Contour Brands, the denim specialist best known for Wrangler and Lee jeans. Over the past 12 months, the stock's up more than 75%. While it stalled to begin 2024, the company reported a great quarter at the beginning of the month. Contour delivered an excellent beat and raise set of numbers that sent the stock up 8% in a single session. It's now up nearly 15% since the quarter. How are they doing it? Earlier today, Contour was at the New York Stock Exchange to celebrate the 5-year anniversary of their spinoff by VF Corp, their former parent company. And we got a chance to speak with Scott Baxter. He's the chairman, president, and CEO. Take a look. Scott, first, congratulations, 5 years. Tell me the journey.
Oh, Jim, it's been an incredible journey of 5 years through a pandemic, supply chain, inflation, all of the above. But we have survived and we have thrived, and our company is doing really well. Thanks for having us on today.
Of course. Now, the Wrangler and Lee that I knew when I first met you and before, radical change. And the radical change is both on the gross margins, which we care about on Wall Street, but also the utility, the doors, the direct to consumer. These have all gotten very hot.
Yeah, we've expanded our D2C business in a significant way. We've expanded our digital business in a significant way, and we've expanded our categories. We're in the outdoor business now. We grew our outdoor business in these last 5 years from 100 million to 200 million. We're in the t-shirt business. Now when we're our own company, we have permission to do the things that are accretive to our balance sheet. So we're doing those things because what we make, we pour into our company.
Well, I also want to point out from our point of view, you poured into the dividend, which was what our viewers like.
Just took a nice increase in the dividend, as you saw, buying some stock back this last quarter, too. So real pleased with how that's going.
All right, let's talk about the positioning of Wrangler. Those who follow country music have suddenly discovered your brand, even though it's always been a great work brand.
Yeah. Well, Jim, I will tell you, we've been in the country music business since 1947 when Wrangler came out. So it's been a brand that's been around forever. But we are number one in denim, we're number one in bottoms, we're number one in tops. And hopefully you saw this week one of our star entertainers that's part of our portfolio, Lainey Wilson, had an amazing night at the Academy of Country Music Awards, winning Female Artist of the Year and then Artist of the Year. So congratulations to Lainey. And we have a collection kicking off with her in the fall, where she's helped us design that collection. So we're really looking forward to that launch.
Okay, now this is the kind of thing I really want to hear because I've always felt these are two solid brands, very undermanaged previously, but I also want to just talk about sport and work. I am an ATG guy. I don't know why, I just found it, but one of the reasons I am is you're cheaper than another brand called Carhartt, but I think every bit as good, if not better. So you're doing something, maybe it's the Project Genius, I don't know how you're getting there, but the stuff is superior. I want people to know that. We're
running a really good business. We've got a really good team. We just put our nose to the grindstone and work really hard. But from an ATG perspective, we think about it like this. That Wrangler brand being attached to ATG brings a lot of consumers into that marketplace. Now they like us for that. But we've always been known, Jim, for being a great brand with incredible value at a price point that every consumer can participate with us.
Well, it's funny. The frugal consumer these days, the Gen X, the Gen Z, they go to Google, right? And they look, and you come in cheaper than everyone in the space. So you must be taking a lot of share.
We've been taking share now for about 8 quarters, and we talk about it on our call a lot, and so it's been very significant, and we've been very pleased with it, as you can imagine. We've got really good channel partners, and we've got really passionate consumers. Plus, some of the things that we're doing around collaborations have been really successful.
Well, speak to me about that, because that's something new, too.
Yeah, so for instance, we've got Stout, our women's collaboration right now. We just did Daydreamer. We just kicked off our new League golf line. You know, we did some insight work. Now that we've gotten past our ERP, so if I can give anybody any advice, don't spin a company off and do an ERP implementation at the same time, and then have a pandemic. But we got through that, so now we can think about our consumers much more intelligently, and one of the things we learned was our male league consumer over-indexed to watching and playing golf, so we kicked off a League golf line, and it's doing really well.
Fantastic. In the meantime, let's talk about something that fell into your lap, what you're wearing. I know that you're not a fashion company, but denim has become the most fashionable theme in women's closets and in department stores.
Well, I can tell you this. One of the things that happened, you know, good and bad, some good came of that pandemic, and that is that everybody went casual, Jim.
Yes.
You know, offices, buildings, you know, restaurants, weddings, it doesn't matter. People used to dress up a little bit more, but now it's very fashionable to wear denim. You know, we make a lot of great denim in a lot of different designs and styles and silhouettes. And so we're catering to the customer. We're giving them what they want right now because our team is really listening.
Well, that's going to be cutting in, I think, to athleisure. And I know that you're not a denigrator of anybody. That's not your style at all. But I will say that one of the reasons I think the Lululemon stock has come down a great deal is because what you're bringing to the party.
Well, our consumers really like what we're bringing to the party, and I think the thing that's happening for us is we're hitting other channels and hitting other categories, and that is how we've been successful. And we're starting to operate better globally, Jim, which has been really important. We've got a little time under our belt. Pandemic's behind us a little bit. Right. I think you're starting to see what the company is going to look like post-pandemic and how it's going to operate post-pandemic.
Well, the analysts seem to be wondering what's going to happen to China. I'm going to go there just because I know that I think your brand could really resonate bigger than it has.
Yeah, we've done a really nice job through the years in China, but then, of course, we hit a tough patch during the pandemic like most. Coming out of that now, but one of the most important things that we have to do right now is refurbish our stores. So we are making a capital investment right now as we speak in our stores, 600 plus stores in Greater China, to go ahead and make sure that we continue to resonate with that consumer there.
Okay, one last thing. In your conference call last, you talked about green shoots for the innovative platform, but it sounds like, I know that when I look at numbers, people might be concerned, well, wait a second, the industry itself hasn't bounced back. Yeah. But the green shoots, isn't it happening?
It's happening right now. I mean, it's happening all around our business. We're kicking off new products. We've got a big second half plan from product introduction, and our innovation pipeline has been very strong. It's been strong for years, and we're not slowing down.
Well, I've got to tell you, I'm so impressed from the time I first met you and for the 5 years and what you've done. It's really terrific. That's Scott Baxter, President, Chair, and CEO of Contour Brands. One of my favorites. I'm so glad to have you on the show.
Thanks, Jim. Pleasure to be here today.
Coming up, cruising for profit? Why it's anchors away for the ship-shape stock. Next.
Lately, a lot of people have been worried that the travel bull market might be on its last legs. And in some areas, the boom certainly seems to be deflating. But only some areas. Parts of travel are still doing fantastically. Consider the case of Norwegian Cruise Line Holdings, one of the major publicly traded cruise plays. Earlier today, Norwegian held an Investor Day event right here at the New York Stock Exchange, where management laid out some very bullish long-term targets. Also gave us a terrific full-year forecast. In fact, they raised their full-year earnings forecast after already raising it when they reported less than 3 weeks ago. That's confidence, and that's why the stock's up almost 8% today. Can it keep running, or should you use today's bounce to jump ship? Let's check in with Harry Sommer. He's the president and CEO of Norwegian Cruise Line Holdings to get a better read of the situation. Mr. Sommer, welcome to Mad Money.
It's great to be here. Thank you so much for having me.
So it looks like those who think that some travel is on its last legs have to be wrong after you being able to raise numbers and be so, let's say, buoyant about the next couple of years.
Listen, we see cruise demand continue to be fantastic. You know, we target the middle and upper tier income consumers, and they continue to be doing well in the current economic conditions. Great confidence, great booking patterns, great book position for the future.
Now, I think people should understand this is something that I knew. Oceania, or the Haven side, you've got an element that almost no one believes is possible in cruising. A tremendous value for what is definitely something that would normally, if you were on land, cost 10 times that.
Oh,
how do you do it?
Listen, we have a very efficient platform. We manage our expenses great, and we are super laser focused on delivering fantastic guest experiences. What we do on Norwegian with Haven, which is what you're referring to, it's our luxury ship within a ship concept, great for multi-generational. Maybe the rich grandparents want to be in something in pure luxury where they have all the amenities, concierge, butler, private dining that they can like, but still have the amenities of a big ship with lots of entertainment, other dining venues, lots of activities to do at night.
Now, I am quite familiar with ROI. Many of our viewers are, but how about ROX, ROX? What is that?
You know, it's a new term that we've tried to instill throughout the company, that people have a balance between return on experience, which we call ROX, and return on our investment, which we call ROI. And if we can balance those things together, we can unlock a great guest experience and unlock great financial results.
Well, I can tell that there are people who are loyal to a fault. Jason, our director, will only go on Norwegian.
We love him.
You should. But there are people who just are Norwegian, and there are people, obviously, who are Royal Caribbean people. But
sure.
What defines someone who's Norwegian?
Listen, a Norwegian guest loves the freedom and flexibility that we provide. We have wonderful ships, all state-of-the-art, all well-maintained. We have lots of different dining experiences, lots of different entertainment. We visit hundreds of ports around the world. We take people to places they want to go, and we do it right. We do the guest experience right.
I also know from my then 26-year-old who took a Norwegian cruise that the idea of who's on these cruises is complete. I mean, in terms of like what older people might think. Younger people recognize that the cruise is frugality and value. And that means to them, in a world where they're always worried about money, which they have to be, inflation and difficult times, it's the only way they can really have luxury.
Listen, we appeal obviously to older customers, but millennial and Gen Z is the fastest growing segment of our cruising right now. They're coming, they're enjoying it, they see the value for the money, but they also appreciate the guest experience. These are consumers that value experiences over things, and the cruise provides experience.
Now, it seems to me that you're one of the reasons why you can afford to be as bullish is it isn't like they're pumping out ships every single day. There's a limited supply of the kind of ship that you have.
Yeah, listen, there are only 3 companies in the world that build ships. And I don't think there's any more coming online.
No.
And when there are only 3 companies in the world that build ships, they can only pump out 3, 4, maybe 5 in a bumper year. It's a 3% supply growth. And when you are inherently constrained by 3% supply growth, there's lots of room for pricing.
Okay, now I've followed your industry for a very long time, and you did something today that I really got to applaud you for. You had a captain speak, which shows me that you are laser focused on what the customer's about. Because we're used to hearing executives, but a captain spoke about what the experience is.
Listen, Patrick Dahlgren, our captain, our chief of vessel operations, 25 years of experience in the industry. He knows what he's doing. He's not just a title of captain. He actually captained ships.
I
he was
love that.
on ships for one of our competitors. But with us today, he's been a tremendous value add with knowledge, expertise, but also a tremendous ally in changing the culture in the company.
Now, in the meantime, you also are using AI to change the culture. Now, AI, a lot of people say, well, wait a second, it's everyone claims they have it, but you've got someone who's really deeply involved with it, who's making it so that your whole cruise line is changing.
Sure. So we have a resident expert, Sky Kelly. He does a great job for us. He's actually known in the industry. He recently had a keynote address at a Silicon Valley conference. That's how well known that he is. But he has a vision. He has a vision. It's not just that he talks at conferences.
No, but
he has
that's
a vision.
all right.
But both on day-to-day stuff like marketing copy and website and translations and fixing things like guest interactions, but also on more deep fundamental things like revenue management systems, itinerary planning. You know, we don't have it all figured out. You know, we're still in the early innings.
I followed your career for a long time. You have a lot of things figured out.
Okay, but thank you so much. But we are super focused that modest investments can have outsized gains on the AI front.
And what's important for us, you know, we're a little pedestrian, but you've got the same revenue growth as Royal versus, say, 2019. But you're at 12.6 times 2024. The other guy's a little bit higher. You have lower debt. There's something wrong with this picture. Your stock stock, I mean, I'm preaching to the choir, but your stock should be higher.
You know, listen, we're happy that the investor day that we had today was acknowledged by the market. Like you mentioned, our stock's almost 8%. Listen, I think we had not put out long 3-year targets. The other cruise lines had.
Right.
We put out those 3-year targets today. We believe they're a compelling message to the market. 245 of EPS, 12% ROIC, delevered by 3 turns, and return to historical margins. We believe that the combination of those few factors unlocks value for our shareholders.
And that's important because you do have debt come due. I was looking at the interest expense, 1.7 for 2024, 2025, 1.3, but you have no problem. No problem paying that.
Listen, a lot of the debt winds up being refinanced anyway.
Right.
The debt that we have to pay out of pocket is about $800 to $900 million a year. We're generating close to $2 billion a year, even more in the out years in terms of operating cash flow. We have the money to pay down that debt, get that delever, have a strong balance sheet, and continue to grow the fleet.
Great investor. One last question: did you ever, for a minute, in the depth of COVID, believe that you guys wouldn't come back?
That's a really good question. I'm sure there may have been a minute, but we worked really, really hard, a word I won't use on TV. We worked really, really hard to get to where we are today, and I'm proud of the team and everything that we did.
Well, you should be. Congratulations. You know, we've been a backer of yours for many years, and I thank you so much. My daughter had a good time. Thanks you. Jason, our director, thanks you. Dylan, thanks you. Excellent. We have big cruisers on our team.
We'll come back soon.
Absolutely. That's Harry Summers, President and CEO of Norwegian Cruise Line Holdings, NCLH, and Mad Money's back after the break. Some would say, here we go again. Palo Alto Networks reported after the close today. For the third straight quarter, the leading cybersecurity firm saw its stock get clobbered. But as I have told you repeatedly, the immediate reaction is not always the right reaction. What happened this time? When you look at the quarter, virtually every line item was great. Even better, management raised every line of their full-year forecast. One fly in the ointment. Palo Alto's quarterly billings came in at $5 million weaker than expected. Now, by the way, that's million with an M. It's practically a rounding error. And that was enough to crush the stock in after-hours trading. If this is anything like the last 2 quarters, the post-earnings pullback could turn out to be a terrific buying opportunity. But you know what? Don't take it from me. Let's dig deeper with Nikesh Arora. He's the chairman and CEO of Palo Alto Networks. To learn more. Mr. Arora, welcome back to Mad Money.
Jim, nice to see you again.
Okay, Nikesh, people are selling the stock right now, and I want you to tell me why those people may not know as much as they think they do.
Well, Jim, we just came off our earnings call, and all I can tell you is we had a better quarter than I expected. We had an uptick faster than I thought we were going to. And part of that was we went out with this idea last quarter that we're going to platformize our customers, because we discovered, and we shared this with the analysts today, that our ARR for customers we fully platformize goes up by a multiple of 10 to 20 times. So that became the right strategy last quarter. We did 65 deals this quarter on platforms. I didn't expect 65. And I need to do about 65 to 70 for the next 5 years to hit $15 billion. This came out of the gate really fast. And part of it was something you've talked about. We had some large breaches out in the market. We were called in to go help fix those breaches. That allowed us to generate tremendous amounts of opportunity for ourselves. But it was an amazing quarter. I think that billings is a broken metric in the market. And people
you have to explain that to us, because obviously the people who are selling disagree with you and disagree with me, because I don't think billings are the correct way to look at your company. I think I look at backlog. I look at RPO. Those seem like a better way to judge. But these people think that this miss, and it is a small miss, should trump everything that you're saying.
Well, Jim, our RPO grew 23%. It's been growing over 20% consistently for the last 3 years. Our implied bookings, which is the amount of business we get in, ticked up from 10% to 17% this quarter. Billings is purely a function of which customers I choose to take money up front from and which ones I agree to annual billings. My business is there. The cost of money is an issue. I choose not to take all these customers and start financing them. I say, fine, you can pay me when you're ready. And that causes the billing metric to get jolted around. Our revenue was great. Our profitability is amazing, and our RPO is amazing, and our free cash flow margins are great. So I don't think there's anything wrong with this quarter.
I think that some people don't seem to think it matters that in the biggest hack maybe of our lifetimes, unfortunately, United Health, they called you in. Now, if they called somebody else in, I think the conversation would be like, how come you didn't get that call? But that somehow the $5 million is more important than the biggest crime, cybercrime, maybe of our era. How did you get that deal?
Well, Jim, look, it is a strong partnership we have with them, and we work really hard with them. We worked really hard to make sure we could connect all the pharmacies back, get healthcare working back in America again. That allowed them to get confidence with us and comfort with us that what we had was what they needed. They had a large vendor sprawl that allowed them to consolidate, that allowed them to put everything on the next generation capabilities, that allowed us to have our largest deal in the history of Palo Alto. I mean, there is another hack out there, which is also in the healthcare industry, where they have also declared on the website they've called Palo Alto in.
I did not know that. That news has not broken yet? Another healthcare hack.
On their website.
All right. Well, I'm going to have to. I know you probably can't disclose it. I'm going to have to do my reporting hat and figure out what that was about. Let's do some reporting on this IBM deal. What does it mean? What does it mean in numbers? Because people don't seem to think it matters for reputation. I do. What do the numbers say?
Well, Jim, as we said on your channel, not your show, a few days ago, Arvind and I came together and said, look, this is an iconic deal in the history of cybersecurity. It's something IBM hasn't done ever. They have gone all in on a Palo Alto portfolio of cybersecurity products. They've decided to take their offerings, merge them with our offerings, and sell them to us. So we are now, will be the owners of QRadar SaaS, which is their SIM product or SOC product, which is a product we launched 15 months ago. And that's a product they're going to now sell for us. 1,000 people at IBM are going to go sell that product with us. We paid $500 million to acquire $100 million of business, which they have in SaaS, and also the option to go ahead and migrate as many of their on-prem customers onto our platform. Their on-prem business, of course, is multiples of their SaaS business. And I think that's amazing. It puts us squarely in the top 3 players in SOCs, where we were not a player 15 months ago. This is a market which is fully driven by AI. That's the solution we have delivered to the largest healthcare provider in the United States.
Can you tell me, there's a major opportunity for cybersecurity in Washington with Thunderdome? I would think that you are certainly part of the picture there.
Yes, so we have said that last quarter, we were the ones who were qualified as Thunderdome vendor, and then it went through its own machinations. Right. But what has happened recently is with a VPN zero-day vulnerability that came out, a lot of the missions came back to us and saying, listen, we already have a frame contract with Palo Alto. Can you help us get this VPN out and get Palo Alto in? So now we're working our way back into all those missions to try and get the Prisma Access solution deployed. And as I said, it won't happen as one big deal, but it's going to happen over time, and we'll get our fair share in that market.
Well, you have to tell you, last quarter was a miss, and I was upset about it. When I saw these numbers, I wasn't upset. I said he did what he said he's going to do it more, and I just sit here and I think, all right, so because the stock was pushed again on Friday, because the stock was pushed relentlessly into the quarter, I think that there were people who got a little too bullish versus a great quarter. That's how I look at it. I don't have any other way to look at it.
Well, Jim, as I said, we've seen this recovery much faster than I expected. We are very excited about the upcoming pipeline. We're into our biggest quarter, into Q4. We see tremendous amounts of opportunity. I have personally inspected the top 500 opportunities at Palo Alto over the last 90 days. There is tons and tons of opportunity. I think our strategy of getting platformization is the right strategy. This market in cybersecurity needs a platform like we have the Workdays, the ServiceNows, the Salesforce of the world. We aim to be that platform. We aim to be the first $15 billion ARR company in cybersecurity, and I hope we get there.
Okay, so what did the Cisco Splunk deal mean for you? Is that an opportunity? I like both those guys.
Look, it is an opportunity for us because that reaffirms to the market that you need a large AI-enabled data lake to be able to deliver great security outcomes, which is exactly where our XIM product is targeted. As customers, see M&A, see acquisitions, they get a little nervous. They start looking at optionality, and we hope that in that optionality, we will get a chance at going in there and showing our capabilities and proving our worth, and we should be able to get some market share as part of that.
All right. Now, I do have to go back to this healthcare because this worries me. Is it another health insurer that got hit? I mean, I personally have been hit by one of the ones that I've been hacked, and I know what it's like to be hacked, and people call you endlessly pretending they know your stuff. Is it going to be another one like that where individuals are going to be hurt, where individuals are going to get called because they sold the information to the bad guys?
No, Jim, it's out in the public domain. It's just interruption of some health capabilities, which we're trying hard to work fast with our client to make sure we bring them back up and running so we can continue to have great healthcare.
And can you tell, look, you're not a B2C, you're not to customer, but what do you tell a person? I mean, we're all getting these calls. We know where they're from. They're emanating from people who bought this information from a major healthcare insurer, and you're getting calls telling you that you're entitled to a certain program. It's all stemming from this darn thing. When will this end? When will people go to jail?
Well, Jim, I think we are seeing more and more enforcement lately. We are seeing the various agencies of government start to coordinate. So I think I'm hopeful about the enforcement actions the government is able to bring. We have seen in certain cases that they've gone ahead and thwarted the attempts at ransomware. So I'm actually cautiously optimistic about what's going on from an enforcement and sort of organizing perspective in terms of how they are. Unfortunately, I think the hacks are here to stay. I think we are going to see more and more hacks going into the election. I think we're going to see more and more deep fakes, more and more AI being used to try and scam people. It is the Wild West as far as the use of AI is concerned. So all I can recommend to everyone is double check everything, make sure you're sure that who you're talking to is the person you're talking to, and make sure you find other ways to validate that this is a real call or a real engagement that you're having.
Got it. Okay, well, look, Nikesh, thank you so much for coming on. Nikesh Arora, Chairman, CEO of Palo Alto Networks. Look, this isn't like last time, but you can go sell if you want. I don't care. I'll buy it from you. Mad Money's back after the break. Thank you. It is time. Some of the lightning round quiz. Remember, that's where Rob Goldberg saying this talks about it, but don't care. Play this out. And then the lightning round is over. Are you ready to keep that cover the lightning round quiz? Let's start with Gabe in Michigan. Gabe.
Hey, Jim. How you doing?
Hey, I'm doing well. How about you, Gabe?
Good, thank you. Hey, long-time viewer and club member here.
Thank you.
Looking at, I think we agree in this company with the outlook of Abbott Labs. Is it hold or buy more?
Okay, the outlook is fabulous. There is a lawsuit in July that involving Formula. Its competitor, Reckitt Benckiser, lost a case. I think that this is not going to be a big deal, but it doesn't matter. People know what happened with J&J, and they're scared. We're waiting till at least it gets to par or 100 to be able to buy more, but we believe in the company. Let's go to Tony in Illinois, please. Tony.
First time, long time, Jim.
Gotcha. What's happening?
I got to give you a mad Chi-Town booyah to you.
Fantastic booyah. I mean, one of the best today. What's happening?
So I'm talking about a stock that I've seen described as a discount or a poor man's substitute for VMware. In March and April, it traded above 66 7 times without ever closing there. Then all of a sudden this month, it's up 20% and it's 72. You think it's going to come back in, or where is Nutanix going to go?
Well, Nutanix is what the market wants right now. It's enterprise software, enterprise cloud platforms. People can't get enough of it. They don't seem to care about the valuation. They just buy. I have too much discipline to recommend that stock at this level. Let's go to Mitchell in Texas. Mitchell!
Yo, Jimmy Choo.
Yes. Hi, chillin'.
How are we doing today, sir?
This is an extraordinarily good day. How about you?
Oh, wonderful. Hey, I got a great stock for you, at least I think. They reported 10% same-store sales growth last quarter. The stock's been an absolute rocket over the last month, and I think it's a good one. What do you think about Dutch Bros? I
completely agree with you. Ever since my daughter introduced me to the Bros back in 2014, I have been a confirmed user and a buyer of the stock, a recommender of the stock for you. It's a little bit too junior for my trust, but I really like it. Let's go to Joe in New Jersey. Joe.
Hey, Mr. Cramer, thank you for taking my call.
Oh, thank you, Joe. What's going on?
Hey, about 2 years ago, I sold this stock at around $28 a share on your recommendation and made a small profit. It's come down to around $13 a share, and with an impressive Q4 result, is Canada Goose a buy?
Okay, I'm going to tell you, I'm going to put my trading hat on. When I see a company report that kind of number that good and it doesn't go up, I say, ain't nothing going to get this thing going. Let's stay away. Let's go to Sanjeev in Texas. Sanjeev.
Hey, booyah, Jim. I've watched you for years, and I have to say thank you so much. I watched you from when my daughter was in diapers, and now she's in college. You've really
she watches.
Her love of stocks.
Oh, great day. That just made my day. Thank you. How can I help?
No, thank you very much. And so the stock I'm interested in to get your take on is Mira GTX. The symbol is M as in Mary, GTX.
Okay. Now, this is my view on that kind of stock. It is a worthy spec. You want to be there because it's limited downside and some nice upside. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
In a normal market, stocks trade on earnings expectations. You beat the expectations, you raise your forecast, and that forces the analyst to boost their estimates, and then your stock goes higher. If you beat the expectations but leave your forecast untouched, your stock goes down, because that's not good enough. And woe to the company that misses the one or both. You might as well be delisted. Oh, it's a tough call, but one that the whole market needs to run through every 3 months. Most recently, Microsoft gave you an outstanding beat and raised quarter, as did Netflix, Alphabet. Their stocks were met with jet propulsion. They haven't looked back. How'd that happen? Simple. The key ingredient is that Wall Street's expectations stayed low, while business accelerated beyond what anyone anticipated. Sometimes when I see these moves, I think that we're actually getting the quarter today that the analysts didn't expect until next year. Which brings me to Wednesday, when Nvidia reports. Now, a year ago, the expectations for Nvidia were incredibly low, at least in retrospect. The analysts didn't see the demand from Amazon, Alphabet, Microsoft, and Oracle. They didn't expect Nvidia could charge as much as it did for its high-end chips. They didn't believe the company could meet demand, even with lots of help from Taiwan Semi. They just didn't see it coming, allowing CEO Jensen Huang to deliver one of the biggest upside surprises in history. This time, though, I hesitate to even watch what's about to happen because I'm cringing. I'm full of trepidation. I still love Nvidia, the company, of course, but the expectations are much, much higher than I'd like. This weekend, I wrote a piece for the Investing Club about the golden quarter these guys reported a year ago. Now the analysts have extrapolated from those great numbers, and they keep saying incredibly positive things about what's coming. It's almost like Nvidia is some artist that just got discovered last year, and his paintings have gone up and up in value every quarter. It's ironic, something I call Jensen Huang the modern-day Da Vinci, because he's a Renaissance man with an uncanny ability to see the future. The most valuable painting ever auctioned is Salvator Mundi by the original Da Vinci. That's an apt analogy if you believe the process of valuing stocks is static, that it's based on something absolute. But in reality, that's not how it works. Jensen speaks of this moment as the iPhone moment for AI. Was June 19th, 2007 a good time to short Apple? Was the split-adjusted $4 and change a great place to bet against that company? I don't think so, given that the stock's now 191. I would say it was a spectacular buying opportunity. He compares it to when Microsoft combined with Intel to make a terrific personal computer. That was a gradual process, but they were in full swing in 1990 when Microsoft traded at just $1 and change on a split-adjusted basis. Buying opportunity. He also compares it to the steam engine, which is a tougher quote to pull, but news to say it changed history. Buying opportunity. And maybe that's what's happening here. Not a beat and raise quarter, but a change in history. Hence why I always tell you to own Nvidia and not trade it. I've said it for years because I believe AI will change history, just like the iPhone or the PC or the steam engine. I wish I'd simply stayed long the PC players for my old hedge fund, not traded them endlessly as I did. Something I stopped doing, by the way, when we bought Microsoft for the charitable trust. I didn't start making big money in Apple until I stopped trading and just sat on the darn thing. And you know what? I feel the same way about Nvidia. Why did I trade in and out of those stocks in the old days? Because every time they caught fire, I feared the expectations. I thought they had gotten too high. I worry about that now with Nvidia, but only from a short-term perspective for those of you who system buying today want to get out Wednesday evening. The AI revolution is ongoing. It can last for years. Look how long Apple's lasted since they changed everything by going handheld. Of course, Apple stock has stumbled many times during that period, and the Nvidia story might appear to be over on Wednesday if they can't keep up with the expectations. I'm sure someone will pull the plug. But if you believe in what they're doing, it's just a bump in the road. So I say forget Wall Street. Don't let your expectations near term get too high. See, that's the real danger. I like to say there's always a bull market somewhere. I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.